There's two types of investors. The first, the one who goes to sleep very carefully, safe, investing into core ETFs that are boring, globally indexed, and lives their life. And the other one that chases higher returns, tech stocks, the name of the month, and simply stresses over chasing wealth. What if I told you that you could be a mix of both worlds, having the safety net, but also trying the thrill of that high risk, high reward tech investment? Now we're going to discuss how to best leverage your portfolio, giving it a right weight as professional wealth investors do. Let's get to it. Hello, fellow wealth seekers! Let's get into the detail. Why do we call it 70-30? 70% is supposed to be the solar system around which everything gravitates. Basically, the core grounded strategy of safe returns that is supposed to ground-proof your wealth. 30% is the spice, the satellites, and in case one of those crashes and burns, your core would see itself unaffected and would continue to generate safer, slower wealth. With the spice, you're supposed to also chase returns that are a little riskier and therefore yielding higher reward. In practice, I'm talking about two indexes that cover the whole world. They are interchangeable, so don't venture yourself in a mix of both. Just stick to one. I tend to prefer FTSE Vanguard, or you can also go for MSCI All World. I prefer the first one simply because it is more indexed. It covers roughly 3,000 companies. That screams diversification, and diversification screams safer returns, essentially. When you focus instead on the first part of your spice, so a following 15% of your strategy, I would recommend US tech. Now, FTSE or MSCI, they are also heavily indexing in tech simply because 30-40% of the world is now tech, but nevertheless, there is some room to play if you want to over-index on the S&P 500, which generally is a little bolder on returns, but also a little more shaky in terms of consistency. So I would recommend you to go for EQQQ, for example, which is NASDAQ, and that should be quite a good coverage. For the last bit, let's be strategic. Europe is stagnating. The US is expensive and riskier. Where next? Well, the next big superpower lies in Asia, and in my eyes, it's India. India with a strong GDP, with strong growth rates, who also has yielded strong returns over the past 5 years. So I would go for MSCI India. 3 reasons that make this the ideal European allocation. 1, psychological. You fend off the FOMO. When people tell you they are picking stocks or they found the next big thing, you're already diversified. You're already doing that. You have your core and your spicier bets. Secondly, accumulating. You already have an edge compared to the US because all the ETFs I gave you have an automating reinvestment of dividends. So you never create capital gains, you never pay taxes, and you grow quietly reinvesting the dividends tax deferred. Thirdly, simply because it is the easiest to automate. When you have these 3 buckets very clear and you have your monthly income, simply make it flow with an automation in buying these 3 tickers and see your wealth easily, automatically replenish itself. I hope this was helpful. If you want to gain more knowledge about the psychology of wealth, I have added a couple of videos precisely on how to trick your brain into saving and investing more. And I have also made videos on the best ETF platforms to leverage. Until the next session, European Wealth Lab out!